I remain Author Saint Vincent, the author of Mathematics and Account. I'm here to present to you some terms related to financial account. When we talk about financial accounting, it involves accounts prepared for external affairs. And in doing this, there are some terms we need to consider as far as financial accounting is concerned. We need to know the classes of accounts. Account actually means the records of money received and spent within one accounting period. Classes of accounts includes 1. Real accounts. Real accounts. Real accounts deals with tangible items such as assets. Examples are motor vehicle account, buildings account, typewriters account, stock account, etc. Number 2 is known as nominal accounts. N-O-M. Nominal. N-O-N-I. Nominal accounts. Nominal account is this class of accounts that records all expenses incurred and the incomes received within one accounting period. That is, nominal account deals with income and expenditure accounts. Examples are purchases account, rent account, discount allowed account, sales account, discount received account, rental income account, etc. Number 3 is known as personal accounts. Personal accounts is another class of accounts that records account of persons. Account of persons, such as individuals like you and I, firms, that's companies, and corporations. It also records accounts of debtors and creditors. Examples of this class of accounts are Vincent account, Jacob account, PZPLC account, Premium Publishers account, INEC, NNPC, and so on. Another subheading on this introduction is called ledger. L-E-D-G-E-R is called ledger. Ledger is the name or principal book of accounts that shows debits and credits. In a simple language, any account that shows debit side and credit side is a ledger. Examples of ledger that we can remember: Vincent account is a ledger. Profit and loss account is a ledger. Trading account is a ledger. Trial balance is not a ledger. Balance sheet is not a ledger. Manufacturing account is a ledger. Buildings account is a ledger. Income and expenditure account is a ledger. Receipt and payment account is a ledger, and so on. Anytime we talk about ledger, we mean that type of account that has debit side on the far left and credit side on the far right. The debit side represents the left-hand side, your left-hand side, while the credit side represents your right-hand side. The word debit, DR, in short form, simply means D for debit, R for records. That means DR means debit records, while CR, which is known as credit, represents C, credits, R for records. So CR, which stands for credit, the full meaning is credit records. So any account that has debit side and credit side is a ledger. And what you need to understand is that account is equal to ledger. Every account is equal to ledger. Every ledger is equal to account. So that means in my classes of account I stated earlier, real accounts can also be known as real ledger. Nominal accounts can also be known as nominal ledger. Personal account can also be known as personal ledger, because ledger and account are equal. So if it's a ledger, it's also an account. If it's an account, it's also a personal ledger, because ledger and account are equal. So if it's a ledger, it's also an account. If it's an account, it's also a ledger. Like I've stated, the definition of ledger. Ledger has different types of group. One, we have what we call the general or impersonal ledger. General or impersonal ledger. General ledger or impersonal ledger includes all the examples of real accounts we stated earlier, and all the examples of nominal accounts, both from what we call general or impersonal ledger. The number 2 is what we call sales ledger. Sales ledger is that type of ledger that records all debtors' accounts. Anything that concerns debtors will be in the sales ledger. The number 3 is called purchases ledger. Purchases ledger records accounts of creditors alone. Anything that concerns creditors are grouped into what we call purchases ledger. Another time to talk about as far as financial accounting is concerned is what we term as cash book. Cash book is a ledger. Cash book, apart from being a ledger, is also a subsidiary. It's also an example of subsidiary books. That book where transactions are recorded first before you post to the ledger, and later extract the trial balance. And from trial balance, we can prepare final accounts, whether trading profit and loss account or what could be termed as statement for profit or loss account, up to balance sheet or what we call a statement of financial position. Cash book is divided into 3. We have the single column cash book. That is a type of cash book that records only one type of transaction. And this single column cash book is further divided into cash account and bank account. The cash account records all transactions involving cash. You pay somebody by cash, you receive money by cash, you purchase goods by cash, you sold goods by cash, everything account. The debit side of cash account records receipts, money coming in, while the credit side of the cash account records payments, money going out in cash. While the bank account records transactions relating to checks. You pay somebody by check, you receive money by check, you sold goods by check, you do everything by check. That will be in the bank account. The second part of the second type of cash book is known as 2-column cash book, a 2-column cash book, or double column cash book. When you say a 2-column cash book, you are referring to that cash book that records only 2 types of transactions. Only 2 types of transactions. 2 types alone. Involving cash and check transactions. And this type of cash book, apart from the knowledge of debiting receipts and crediting payments, there's inclusion of what we call contral entries. Contral entries simply means payment of money from cash to bank and vice versa. By the time we add discounts on both sides of a 2-column cash book, that is, discount allowed on the debit side of the cash book and the discount received on the credit side of the cash book, we have another type of cash book known as a 3-column cash book. For a 3-column cash book, this is a type of cash book that records only 3 types of transactions, namely cash, checks, and discounts, which is divided into discount allowed and discount received. Do not forget, discount allowed is found at the credit side, on the debit side, discount allowed is found at the debit side of a 3-column cash book, while discount received is found at the credit side of a 3-column cash book. There's also the presence of what we call contral entry, like I have earlier stated. Cash book is similar to the receipts and payments accounts, which means receipts is on the debit side of the cash book, while payments is on the credit side of the cash. Another term to talk about, which is very important, is a double entry principle or double entry system. This is what we term as a cardinal rule in accounting. The principle that is acceptable all over the world. That principle was developed in the 15th century by a man known as Luca Pacioli from Venice, Italy. The man is regarded as a father of accounting. The man stated in his mathematics textbook what double entry principle is all about. The man states, and I quote, that for every debit entry, there must be a corresponding credit entry, and vice versa. What that one simply means that if a transaction is on the debit side of an account, when you are posting to ledger, that transaction on debit will be transferred to the credit side of the corresponding account. Or if that transaction is on the credit side of an account, it will be transferred to the debit side of the corresponding account. That is the meaning of double entry. Simply put, transactions must be recorded twice. There must be debit and credit, or credit and debit. They cannot be debit, and it cannot be credit. That is the principle of double entry. I further state here that principle simply tells us that the receiver must be debited, while the giver should be credited. In this particular subject called accounting, transactions to me is divided into two. It's either you are dealing with the transactions without money, or you are dealing with the transaction with money. When there is money involved, it could be cash or check. And when there is money involved, the question you ask yourself is, who is receiving money and who is giving out money? The person receiving money is the receiver, and the account must be debited. And the person giving out money is the giver, and the account should be credited. If there is no money involved, it means the transaction is on credit. And when it's on credit, it means money is not paid at the point of sale or at the point of purchase. It means you are buying and will be expected to pay later. In that kind of situation, money is not exchanging hands. What is exchanging hands at that time is goods and services. The question you ask at that time is goods and services. The question you ask yourself in this respect, who is receiving goods or services? And who is giving out goods or services? The person receiving goods is the receiver, and the person giving out goods or services is the giver. So at every point in time, whether it's on credit or there is monetary value involved, the question you ask yourself is to debit the receiver and credit the giver. As far as the principle of double entry is concerned, the watchword here is, or that you need to remember, is that the receiver must always be debited, while the giver should always be credited. And that is the principle behind the double entry system in this subject called accounts. Another subtopic to look at is what we call trial balance. Trial balance is not an account. Trial balance is not an account. When we say it's not an account, it means it does not follow the principle of double entry. It's not an account, it's not a ledger. That means the double entry is not applicable to it. If the ledger is debited, the trial balance will be debited. If the ledger is credited, the trial balance will be credited. Trial balance is not an account, but a list, L-I-S-T, a list of all ledger balances or extracts or postings. The trial balance is prepared to determine arithmetical accuracy. Another thing to look at is what we call source documents. Source documents are those, as the name implies, is a source of accounting information made available to accountants during preparation of financial statements or data. Examples of source documents are receipts, checks, invoice, debit notes, credit notes, LPO, IOU, and so on. Another thing to look at is called journal. Journal is basically divided into two. We have the subsidiary journal, that type of journal that records all credit transactions, sales journal, purchases journal, returns inwards journal, returns outwards journal. Those are the kind of journal we call the subsidiary journal. The number two is what we call general journal, or journal proper, or principal journal. That's the kind of journal we use in recording the opening and closing entries. Correction of errors and other transfers. That is all I can possibly take in this particular class. My name still remains Author Vincent Nwankpa. Put your comments in the comment section. Ask your questions. I'll be ready to reply your messages. Remember to subscribe to our YouTube channel, Premium Publishers. God bless you and keep on studying. God bless you in Jesus' name. Amen.